Welcome back to the deep dive. Today we're tackling something really fundamental for W-2 earners. We want to help shift you, the listener, away from just thinking about taxes in April.
Right. It's about moving from that reactive scramble to file on time to actually being proactive, planning your taxes all year round to optimize, not just comply.
Exactly. It's about fundamentally changing how much you end up paying. So we've looked through all the sources you sent, and they really zero in on two basic tools the IRS gives us.
That's right, deductions and credits. And our mission today really is to get crystal clear on which one is more valuable, why that is, and how it shapes your strategy.
Okay, let's dive into that because honestly, these terms get thrown around, and I think a lot of people find them confusing.
Yeah.
Let's start with the one we hear all the time, the tax deduction. What does it actually do?
Okay, so a deduction reduces your taxable income. It shrinks the pot of money that the government actually gets to tax.
Right, so it lowers the income figure first. If I manage to get, say, a $1,000 deduction, how much money does that really put back in my pocket?
Well, that's the key thing. It depends. It totally depends on your marginal tax bracket, the rate you pay on your last dollar of income.
So if I'm in the 22% bracket?
Then that $1,000 deduction saves you $220. 22% of $1,000. If you're a higher earner, maybe the 35% bracket, it saves you $350. So deductions are good, definitely, but their value is tied to your tax rate.
Got it. Okay, so then how is a tax credit different? And why do the sources say it's, well, superior?
A tax credit is much more straightforward. It's a direct reduction of your actual tax bill, dollar for dollar.
Okay, so if I have a $1,000 tax credit.
It cuts your tax bill by the full $1,000, period. It doesn't matter if you're in the lowest bracket or the highest bracket. That $1,000 credit is worth exactly $1,000 in savings. It's just more powerful.
And that leads us to something really important for working families, right? Refundable credits.
Yes, this is where credits get really powerful. See, a non-refundable credit can only zero out your tax bill. If your tax is $800 and you have a $11,000 non-refundable credit, you pay zero tax, but you don't get the extra $200. But a refundable credit, that can take your tax bill below zero. If your tax is $800 and you have a $1,000 refundable credit, you pay zero tax, and the IRS sends you a check for the extra $200.
Wow. Okay, that's a huge difference. That's literally cash back from the government.
Exactly. Absolute game changers, especially for folks with lower or moderate incomes.
All right, so that basic difference, deductions reduce income, credits reduce tax, is critical. Now, let's talk about a huge shift that happened because of tax law changes. The standard deduction.
The standard deduction revolution, as some call it. Basically, before you even think about specific deductions, you face a choice. Take the standard deduction amount set by the IRS or add up all your individual itemized deductions.
And you just pick whichever one gives you the bigger reduction in taxable income.
That's the goal. Simple as that.
And the Tax Cuts and Jobs Act, the TCJA back in 2017, it really shook this up, didn't it? The standard deduction amounts just exploded.
They really did. For 2024, we're talking $14,600 for a single person, $29,200 for a married couple filing jointly. Those are big numbers.
Why? Why did they make it so much higher all of a sudden? Was it just inflation?
No, not just inflation. It was a fundamental restructuring. The TCJA got rid of something called the personal exemption. You used to be able to subtract a few $1,000s for yourself, your spouse, each kid.
Right, I remember that.
Well, when they eliminated that, they had to seriously bump up the standard deduction. Otherwise, tons of middle-class families would have seen a pretty big tax hike. It was a balancing act.
Okay, that makes sense. So what was the practical effect on taxpayers? Did people change how they filed?
Oh, dramatically. The data is really clear. Before the TCJA, back in 2017, something like 31% of taxpayers itemized their deductions. By 2022, that number crashed down to just 10%.
Wow, only 1 in 10.
Yep. The bottom line is the vast majority of W-2 earners, probably you listening right now, are taking the standard deduction.
So if almost everyone takes the standard deduction now, does that mean we can just, I don't know, stop worrying about tracking deductions altogether, like medical miles or charitable donations?
Well, not entirely. But it absolutely means you need to shift your focus. Because that standard deduction is so high, the most valuable strategies for most people are the ones that reduce your income before you even get to that standard versus itemized decision point.
Okay. The above-the-line strategies.
Exactly. These reduce your adjusted gross income, your AGI, directly. And the beauty is you get this benefit even if you take the standard deduction later on.
Right. So let's get into those. This feels like the real cornerstone for W-2 tax planning now. those pre-tax contributions.
Absolutely. These are your biggest levers if you're taking the standard deduction.
And the most common one has to be the traditional 401k or maybe a traditional IRA, right?
Definitely the most seamless.
Yeah.
The money comes out of your paycheck before taxes are calculated. It just automatically lowers the wages reported in box 1 of your W-2 form at the end of the year. It's like automatic tax savings.
And those contribution limits keep going up. For 2025, it's what, $23,500?
$23,500, correct. Plus, if you're 50 or older, you get that extra $7,500 catch-up contribution, so potentially over $30,000 in pre-tax savings.
Okay, so that defers tax, which is great. But there's another layer here, especially for low to moderate income earners, isn't there? Something called the Savers Credit.
Yes. This is fantastic and often overlooked. The Savers Credit, officially the Retirement Savings Contributions Credit, lets you kind of double dip.
How does that work?
Well, you already got the tax deduction for putting money into your 401k or IRA, right?
Yeah.
Reduce your taxable income. The Savers Credit gives you a tax credit, that dollar-for-dollar reduction on top of the deduction based on the amount you contributed.
So you get both. Deduction and credit.
You got it. The credit percentage depends on your income, ranging from 10% up to 50% of your contribution capped at a certain amount.
Okay, give us an example. Make it real.
Sure. Let's say you're a single filer and your adjusted gross income is around $23,000. You'd qualify for the top tier, the 50% credit. If you manage to put $1,000 into your traditional IRA, first, that $1,000 contribution reduces your taxable income by $1,000. That's the deduction. Then, come tax time, you also claim a $500 tax credit, 50% of your $1,000 contribution, which directly cuts your tax bill by $500.
Wow. So that $1,000 saved nets you the income reduction plus $500 cash back, essentially.
Precisely. It's a huge incentive from the government to encourage saving, especially for those who might find it hardest to save.
That's incredibly powerful.
Yeah.
Okay, moving from retirement to health. The sources all rave about the health savings account, the HSA. The triple crown of tax saving.
It really earns that title. But first, the big qualifier. You must be enrolled in a high-deductible health plan, an HDHP, to be eligible to contribute to an HSA.
Right, that's the key requirement. Assuming you have an HDHP, what makes the HSA so special? The triple crown.
Okay, here it is. 1, your contributions go in tax-free, usually straight from your paycheck, pre-tax. 2, the money in the account grows tax-free. You can often invest it. And 3, withdrawals are completely tax-free as long as you use the money for qualified medical expenses.
Tax-free in, tax-free growth, tax-free out for medical. That's pretty unbeatable. What are the limits for 2025?
For 2025, the limits are $4,300 if you have individual HDHP coverage and $8,550 for family coverage.
Now, how does this compare to the other health account, the flexible spending account, or FSA? What's the big difference?
The biggest difference is longevity and flexibility. FSA funds, as many people know, generally have that use it or lose it rule. You have to spend most of the money by year end.
Right, that annual scramble to buy glasses or first aid supply.
Exactly. HSA funds, they roll over indefinitely. There's no deadline to spend them. The money just stays yours and can keep growing.
And what happens later in life? Say, retirement.
That's where the HSA gets even more interesting. After you turn 65, you can withdraw HSA funds for any reason, not just medical expenses, without paying a penalty. If it's not for medical, you'll pay regular income tax on the withdrawal, just like you would from a traditional 401k or IRA.
So it effectively becomes another retirement account after 65.
Pretty much. A very flexible, tax-advantaged one. It makes it a really powerful long-term savings vehicle, not just for current health costs.
But again, you need that high deductible health plan. So for W-2 earners who don't have an HTHP, the flexible spending account, the FSA, is still a valuable tool, right?
Oh, absolutely. Using pre-tax dollars for predictable medical costs, co-pays, prescriptions, dental work is always a win. You just have to be really careful estimating your expenses because of that use it or lose it aspect. Some plans might let you carry over a small amount, but you can't count on that.
And within FSAs, people should really pay attention to the dependent care FSA option during open enrollment, shouldn't they?
Definitely. If you pay for childcare, daycare, after-school programs, summer camp so you can work, the dependent care FSA lets you use pre-tax dollars for those costs, up to certain limits. That's a direct way to lower the effective cost of childcare, which is a huge expense for many families. Another great above-the-line benefit.
Okay, so we've covered optimizing your paycheck deductions through retirement and health accounts. Now let's shift focus to tax filing time. What are the big levers there, especially the credits?
Right. Back to credits, the dollar-for-dollar savers. And for families, these are often the most
Let's start with the big one. The child tax credit, the CTC.
Okay, the CTC gives you a credit of up to $2,000 for each qualifying child under 17. A portion of it can even be refundable, meaning you get it back even if you don't owe tax.
And what's key here, according to the sources, is how widely available it is, right? The income limits are pretty high.
Exactly. The credit starts to phase out, meaning it gets reduced, only when income hits $400,000 for married couples filing jointly and $200,000 for other filers. So a very large number of W-2 families, even those with fairly high incomes, can still claim the full credit.
That's important. Now, for lower and moderate income earners, there's an even more significant credit, the Earned Income Tax Credit, or EITC.
The EITC is huge. It's widely considered one of the most effective federal anti-poverty programs. It's a refundable credit designed to supplement the wages of lower-paid workers, especially those with children.
And it's crucial that people claim it if they're eligible, even if they wouldn't normally have to file taxes because their income is too low.
Absolutely essential. You have to file a return to get the EITC, even if you owe no tax. Leaving it unclaimed is leaving potentially thousands of dollars on the table.
Now, the sources mentioned something tricky about the EITC, this idea of an implicit surtax when your income is in the phase-out range. Can you break that down? It sounds a bit technical.
It is a bit nuanced, but really important. Like many credits, the EITC gradually reduces as your income goes up once you pass a certain threshold. That reduction is the phase-out.
Okay.
So imagine you're in that phase-out range. For every extra dollar you earn, you lose a certain percentage of your EITC. Let's say the phase-out rate is 15%. If you earn an extra $1,000, your EITC might shrink by $150.
So earning more money actually makes part of your credit disappear.
Precisely. So the effective tax rate on that extra $1,000 isn't just your regular income tax bracket, say 10% or 12%. It's your regular bracket plus the 15% EITC reduction you just triggered.
So your total hit on that extra $1,000 could be like 25% or 27%, even if you're technically in a low tax bracket.
Exactly. It creates this hidden or implicit surtax in that specific income zone. It can feel like you're working harder but not getting ahead as fast because the credit shrinks as your earnings rise. It's a planning point, especially if someone is considering taking on extra hours or a side job.
That's a really important subtlety. Okay, moving on. Let's talk about home ownership. For years, the thinking was buy a house, automatically itemized deductions, the big ones being mortgage interest and SALT.
Right. Mortgage interest deduction, though it's capped based on debt amount, currently $750,000 of mortgage debt qualifies, and the SALT deduction state and local taxes, which includes property taxes plus either income or sales taxes.
But that SALT deduction got famously capped, didn't it?
Yes. The TCJA capped the SALT deduction at $10,000 per household per year, for 2024 anyway. That was a huge change, especially for people in high-tax states.
So with that cap and the huge standard deduction we talked about, is itemizing still the default for homeowners?
For many, no, not anymore. Let's use that source example. A single W-2 earner pays, say, $8,000 in mortgage interest and hits the $10,000 SALT cap with their property and state income taxes. That's $18,000 in itemized deductions.
Okay, $18,000 sounds like a lot.
It is, but compare it to the standard deduction. For 2025, the single standard deduction is projected to be around $15,750. In this case, itemizing is better by about $2,250. But change the numbers slightly, maybe less mortgage interest or lower state taxes, and it flips quickly.
Like the other example, $8,000 interest, $5,000 property state tax, that's only $13,000 total.
Right, and $13,000 is less than a $15,750 standard deduction, so that homeowner would absolutely take the standard deduction. They get a bigger tax benefit that way.
So the key takeaway for W-2 homeowners is, don't assume. You have to actually run the numbers each year. Add up your potential itemized deductions, mortgage interest, SALT up to the cap, maybe significant charitable donations, and compare that total to your standard deduction amount.
Exactly. The days of automatically itemizing just because you have a mortgage are largely over for a big chunk of W-2 earners. Always check.
All right. One last point in this section. Marriage. Getting married obviously changes your filing status, but how does it impact taxes? Can it help or hurt?
It can do both. There can be a marriage bonus, often when one spouse earns significantly more than the other. The higher earner's income gets pulled into lower tax brackets by the lower earner's income when filing jointly.
Okay, that's the bonus. What about the marriage penalty?
The penalty often hits couples where both partners earn similar, relatively high incomes. Filing jointly pushes their combined income into a higher tax bracket much faster than if they had filed as single individuals.
But it's not just high earners, right? You mentioned low-income couples can face a penalty too, especially with the EITC.
Yes, this is critical and often overlooked. Remember how the EITC phases out based on income? The income limits for married couples filing jointly are not simply double the limits for single filers.
Okay, so two people might qualify for the EITC individually.
Correct. But when they get married, their combined income might push them over the married filing jointly income limit or significantly reduce the credit they receive compared to what they got separately. It can feel like a penalty for getting married purely from a tax perspective, especially for those relying on that credit.
Wow. Okay, the complexity really underscores why we need that proactive mindset you talked about earlier. Tax planning isn't just an April thing, it's year-round. Can you walk us through that four-quarter strategy?
Sure. Think of it like a cycle. Q1, right after you filed last year's taxes, is your tax review time.
So looking back at the return you just filed.
Exactly. Analyze it. What credits did you get? How much tax was withheld overall? What were your 401k or HSA contributions? Did you get a massive refund?
If you got a huge refund, that's not necessarily good news, is it?
Not really. It means you overpaid your taxes throughout the previous year. You essentially gave the government an interest-free loan.
Which leads perfectly into Q2, the mid-year checkup.
Right.
This is about fixing that loan problem, right? Adjusting your W-4.
Precisely. Your Form W-4 tells your employer how much tax to withhold from each paycheck. If you got a big refund, you need to adjust your W-4 to have less tax withheld going forward. The IRS has a great online tool, the tax withholding estimator, that helps you figure out the right W-4 settings.
The goal being to get closer to zero owed, zero refunded at tax time.
That's the ideal, yeah. Keep your money in your pocket during the year, not the government's.
Okay, then Q3 rolls around, late summer, early fall. What's the focus then?
Q3 is often benefits review time. This frequently lines up with your employer's open enrollment period for health insurance and other benefits. This is your prime opportunity to make conscious decisions about next year's health plan, choosing an HDHP to enable an HSA, perhaps.
Yeah.
And deciding on FSA contributions, especially that dependent care FSA. It's also a great time to check your 401k contribution rate and see if you can bump it up for the rest of the year.
So Q3 is locking in those big pre-tax decisions for the future.
Right, and then Q4, the end of the year, is the final review, the last chance saloon.
What happens in Q4?
This is where you make sure you've maxed out contributions, if that was your goal, especially for 401ks and HSAs, as IRA contributions can sometimes be made up until the tax filing deadline. It's also the time for year-end strategic moves, like if you have investments in a regular brokerage account, considering tax loss harvesting.
Okay, tax loss harvesting. Sounds sophisticated. How does that actually work for a typical W-2 earner? Maybe someone who just has some ETFs or mutual funds outside of retirement accounts.
It's actually pretty straightforward conceptually. If you have investments that have lost value, they're worth less than you paid for them, you can sell them to intentionally realize that loss.
Why would you want to realize a loss?
Because that loss can offset taxable gains. If you sold other investments for a profit earlier in the year, the loss can wipe out the tax on those gains. Even better for a W-2 earner, if your losses exceed your gains, you can use up to $3,000 of that excess loss each year to directly reduce your ordinary income, your W-2 wages.
Wow, so selling a losing stock could directly lower the tax on your salary.
Up to $3,000 per year, yes. It's a direct reduction to your AGI. Any loss beyond that $3,000 can be carried forward to future years.
That seems like a smart move if you have investments that are down. But there's a catch, right? The IRS has a rule.
Yes, the crucial warning. The wash sale rule. You can't just sell an investment for the tax loss and then immediately buy it right back.
What does the rule say specifically?
It says you can't claim the tax loss if you buy the same or a substantially identical security within 30 days before or 30 days after the sale. So there's a 61-day window around the sale where you have to avoid repurchasing that specific investment if you want the loss to count for tax purposes.
Okay, good to know. Need to be careful there. Finally, let's touch on something often overlooked. Employer fringe benefits. We focus so much on salary.
But your total compensation is much more than just your paycheck. Many valuable benefits your employer provides are actually tax-free to you. Think about the portion of your health insurance premium your employer pays that's value you receive, but it's not taxed. Or employer contributions to your 401k or HSA, or things like educational assistance up to certain limits, or maybe commuter benefits.
How about that a tax saving?
It's tax saving by avoidance. That value never even shows up in your gross income in the first place, so it's never taxed. It's hidden tax optimization built into your compensation package.
That's a great point. Don't forget the value of those untaxed benefits. Okay, so wrapping this all up, what are the absolute key takeaways for you, the listener, the proactive W-2 earner?
I think it boils down to this. 1, understand the power difference. Credits are generally better than deductions because they reduce your tax bill dollar for dollar. Prioritize them. 2, because the standard deduction is so high now, focus your energy on those above-the-line strategies. Maximize pre-tax contributions to your traditional 401k IRA and especially your HSA if you're eligible. 3, don't be reactive. Plan continuously throughout the year, manage your W-4, make smart choices during open enrollment, review at year-end.
Proactive, not reactive. Focus above the line. Credits over deductions where possible. Makes sense.
And maybe one final thought to leave you with, circling back to that HSA, the health savings account.
Okay.
We talked about its triple tax advantage and how it becomes like a retirement account after 65. But there's another feature that makes it incredibly powerful, especially compared to traditional IRAs or 401ks. HSAs have no required minimum distributions, or RMDs.
RMDs. Those mandatory withdrawals the IRS makes you take from retirement accounts starting in your 70s.
Exactly. Traditional IRAs and 401ks force you to start taking money out and paying taxes on it, usually starting at age 73. HSAs, no RMDs, ever, during your lifetime.
So you could potentially let that HSA money grow tax-free indefinitely, using it only when needed for medical costs, or just letting it compound for decades.
Precisely. It turns the HSA from just a health spending tool into a potentially phenomenal long-term tax-free investment and even estate planning vehicle. It adds another layer to that decision between an HSA and an FSA. It's not just about this year's copays. It could be about wealth accumulation decades down the line.
That really elevates the importance of the HSA decision, isn't it? A long-term perspective.
It certainly does.
Fantastic stuff. Thank you so much for breaking all that down, and thank you, our listener, for sharing your sources and joining us for this deep dive into tax optimization. We really hope this empowers you to start thinking proactively about your taxes starting, well, right now.